Hello folks, Steve Lenz here with Discover Options here at Option View Systems International. Welcome. We have 3 reports for you today. These will be for Friday ending February 16th, getting ready for Monday, February 19th. Presented materials for educational purposes only. Should not be construed as personalized financial advice. Past results not necessarily indicative of future performance. If you are an advanced options trader, these reports are for you. We will help you determine whether or not now is a good time to put on a Condor or butterfly campaign. Also, for those of you that are like to sell puts in various ways, bull put spreads, for example, we have a bull put spread timing report. All of these are in the S&P 500, of course. Finally, we have a directional likelihood report indicating which way the market is likely to go in terms of direction and even volatility. So, with that said, let's go to, I want to make sure that you see that you can get a free free ebook, Simple Steps to Options Trading Success. Please just click on the link, give us your information, we'll get that right out to you. Also, if you could please subscribe, that way you will get alerted when we come out with new videos. All 3 reports pertain to the current market condition, and we define current market condition in terms of 3 dimensions: price action, trend, and then the overbought oversold indicator, stochastics. In terms of price action, we had 2 consecutive upswing bars lately. These bars happened when the trend is above, and that should say 65-day simple moving average, not 50. I did change it just for this to kind of account for how close we were to the 50 before. So we're using 65 simple for this particular market condition. And then in terms of the stochastics, we are at 55, which is between 35 and 75, and we are above %D, that 3-day simple moving average of the stochastic. So this makes for a market condition that has occurred roughly about 167 times since Jan of 2000. So that's the population of occurrences that we're using here today, which is pretty darn good. With that said, let's go to the first report. Let's go right here. There we go. This is the Condor butterfly timing report. So since Jan of 2000, we've had about 4,575 daily closes of the S&P 500. Now, of those 4,575, 65% have been favorable bars for selling option premium, where the actual subsequent 21 bar movement was less than what the SIBO skew adjusted VIX was implying, what the option prices were implying. So once again, almost 2/3 of the bars on the S&P 500 since Jan of 2000, almost 2/3, were favorable bars. They turned out to be favorable bars for selling option premium because the actual movement was less than what the option prices were implying through the implied volatility. So, and as I mentioned, our current market condition has occurred 167 times. Of those 167, 65.9% of the bars have been similarly favorable for option premium selling. So pretty much it's a wash. Okay, pretty much it's a wash. Just barely even hardly a percent, 0.9% is the edge that we have here. That's what's implied, is a selling edge of roughly 0.9%. Statistically, it's slightly more likely than usual that this market condition will end up being a favorable one for market neutral option premium selling. It's pretty much a wash, folks. But I wanted to report it. We're right there. I mean, not really too much of an edge over and above what the S&P 500 normally is going to give you, which, turns out to be, pretty much the options are slightly overpriced anyway. It's just that we're looking for the additional edge that this kind of analysis can give you. Now, for those that like to sell puts through out-of-the-money bull put spreads in the S&P 500, perhaps you're using something like the Jade Lizard approach, or you're using a hedged bull put spread that we teach at Discover Options. That's what this report addresses here. So, as we mentioned, we have 4,575 daily closes. Now, we're presuming when you sell these puts, you're a standard deviation away about 30 days out. All right, so if that's the case, and we're looking at those 4,575 daily closes of the SPX, of those, 83.2% of those 4,575 have been favorable bars for selling put premium, where the actual movement to the downside, the 1 month movement to the downside, 21 trading bars, was less than what the SIBO skew adjusted VIX was implying to the downside. Okay, so 83.2% of the time the market does not move down and hit that, what would be your puts down there. It stays above where those puts would be a standard deviation away. So you could flip a coin, 83.2% of the time, you're going to land on a bar that turns out to be favorable for selling puts at that in that situation. Now, also during this time, our current market condition occurred 167 times. Of those, 80.2% of the bars were favorable for put premium selling, like I mentioned. So then technically we have a negative edge, a selling edge of negative 3%, because you could flip a coin and get 83.2, but our current condition, it turns out to be 80.2. So it's not as good. Statistically, it's more likely than usual that the current market condition will be one that is unfavorable. It's slightly more likely to be unfavorable for selling out of the money put premium. No guarantees here, right? I mean, you could still sell put premium out of there and you still have an 80% chance of getting it right just by flipping a coin, or at least under our current condition, 80%. So that's where we're at, and I hope that's helpful in helping you decide which way to go here on this week's trading. In terms of the likelihood report, what we like to do is answer the question based upon our current market condition. What's the S&P likely to do? Go up, down, or wobble around for a bit? And to answer that question, we use price distribution bands, and we'll come back to this screen in just a second. But these bands are positioned above and beneath the close, and in this case we're going out 5 days, and they're set 1 standard deviation away from the close, both above and below the close, and we monitor for every close whether the market in 5 days goes up and hits the upper band, or hits the lower band, or wobbles around. And we keep statistics on every single close going back to Jan of 2000, 4,575 closes. We do this not only for the 5-day bands, but we look at the 10-day bands and the 15 to just get a good feel for the price distribution. The price distribution. And when we go to this report, then we go to the top, and we can see out of 4,575 closes, the upper 5-day band was struck 21.9% of the time. The lower 5 was struck 16.4%, and the rest of the time it didn't hit either of the bands. We have the upper 10 at 16.3, the lower 10 at 16.7. The rest of the time it stayed within the bands and didn't hit either one. The upper 15-day band, 15.6, the lower 15, 19.5, and again, the rest of the time it resided in between. Now, when we go to the occurrences, and this does not include consecutive occurrences, 124 non-consecutive occurrences of our current market condition, look at this. The upper 5-day band was struck 15.3% of the time. That's less than the benchmark of 21.9. And we can see that negative number in red. So not only for the upper 5-day band, but the upper 10 and the 15 and the lower 5 were struck less often than the benchmark up there. Do you see that? The lower 10 was struck a little more often, the lower 15 slightly less. This is a picture in general of lower market volatility, okay, particularly to the upside. Those upside bands are getting struck quite a bit less often than the downside bands. Okay, now let's go and look. Now I also break it out and I say, you know what? Let's go to Monday's open and wait. And if Monday's high, or excuse me, if on Monday price ascends above Friday's high, what's the distribution then? And that's what we're looking at here. Okay, that occurred 84 times where the previous day's high was exceeded. And here we have a situation where the upper bands are struck less often and the lower bands are struck a bit more often. So this is kind of beginning to paint a picture. If you had to lean it a certain direction, you would lean this bearish. If you had to pick a direction, you would lean it bearish because the upper bands are getting struck less often than the lower bands. Let's go now down to the case if the low from Friday gets exceeded on Monday. If the low gets exceeded, interesting how you then have kind of an explosion in volatility in general. 57 occurrences in that particular case. The upper 5 is struck less often by just a little bit. All 5 of the upper bands, all 5 of the other bands are struck more often. In particular, the lower bands get struck quite a bit more often. So what we're seeing here is a bearish bias, and that's why you saw the bull put spread, the bull put spread timing report was negative, because you do have slightly bearish bias here based upon the past occurrences of our current market condition. If you had to pick, you could sell bearish. You could select, elect to go bearish here and sell call spreads, out of the money call spreads. There's no guarantee here, of course, but look how often the upper 5-day bands or the upper bands get struck here. 15, 12, and 11%, roughly 12, 19, 17. So, one time in 5, one time in 6 or 7. You have to be, prepared for that. But the lower bands get struck certainly quite a bit more often than the upper bands. Again, a bearish bias here. Folks, thanks for joining us. I'm Steve Lentz with Discover Options. We will see you next week. Have good luck trading this week. Take care.